Hello, everyone. Welcome to Beacon Pointe's Foundations of Finance course. Today is our second class of the series, continuing our learning of economic basics, including stocks, bonds, and alternative investments. My name is Sydney, and I'm a marketing associate for Beacon Pointe and have the pleasure of introducing you to our professors for today's session, Dylan McDonald and Matt Henn. Dylan and Matt, both Southern California natives, are based in Beacon Pointe's Newport Beach office. They are both certified financial planners, with Matt also holding the Retirement Income Certified Professional designation. Together, they've guided many clients and their multi-generational families in building comprehensive financial plans and coordinated investment portfolios. Before we get started, a quick note. If you have any questions during this pre-recorded session, email us at info@beaconpointe.com with the subject line Foundations of Finance Class 2 questions, and we'll follow up with answers. That's all for class prep. Dylan and Matt, the floor is yours.
Thanks, Sydney.
Sydney, appreciate the introduction. First and foremost, credit to everyone joining us during their summer hours this year. We appreciate seeing you all. Matt and I always look forward to hosting this webinar together once a year. And without further ado, if we thought we'd get into the agenda for today in terms of the topics that we'll be covering. First and foremost, I think the users of capital is an important topic because users of various investments that can take different shapes and forms, can certainly vary from individuals, businesses, and different government municipalities around the country. So we'll go into how those can vary in a little bit more detail. Providers, or we look at this as investors of capital, the different shapes that those can take. Asset allocation. So Matt and I will start to tag team this topic a little bit as well. How to design portfolios in a way that balance stocks versus bonds versus alternative investments that we'll be discussing that meet your and various investors' risk tolerance and their short and long-term goals. The role of alternative investments, and this is an important topic, especially in today's investment environment, because contrary to common misconception, alternative investments don't just insinuate aggressive or risky investments, if you will. There's different alternatives that can take more of a protective or capital preservation approach, and Matt's going to get into those in a little bit more detail. We'll discuss risk tolerance and what's to come here over the remainder of the summer and how to keep in touch with us. So to get into users of capital, we think it's always important to set the table with how the different shapes that users of capital can take. And as I alluded to on the introductory slide or our agenda slide, you can look at users of capital as either individuals, so everyone here on this webinar today, if any of us have ever worked a job in our life or received a paycheck, we've received capital in some way, shape, or form. So the way I like to look at it is anytime we receive a paycheck or cash deposited into our bank accounts, we have decisions on how we're going to use that money on a going forward basis. So some of us might have student loans to be paying down. Some of us might prioritize putting money into our 401ks or putting money into a post-tax investment account. So again, can definitely vary in terms of the uses and situations that will apply and use the money that we receive, but individuals are very common users of capital. Corporate America, so we think about companies around the globe and specifically in the United States. Both small and large companies have to evaluate not just their business needs, but also the macroeconomic environment to determine the best ways to put money to work. And a lot of times when we think about corporations as users of capital, we have to remember that they're using money to finance their revenue streams, right? So to put money to work in order to drive revenue. So you think about Apple using capital to build more warehouses, to potentially build more iPhones, things of that nature. Governments and various municipalities around the country can be another form of users of capital. And the example I like to look at here is we think about different projects that can take place in cities, states across the country Examples include, building roads, different various forms of infrastructure, even sports stadiums that municipalities will share some form of financing in. They'll need capital injections in order to finance those projects. So they take a lot of varying shapes, but definitely different ways to consider users in that situation. Companies also have to evaluate when it comes down to how they're to use capital injections into the business, how to go about seeking new capital injections. So it's not just as simple as issuing debt or issuing equity, but typically what it would start with, if we think about a corporation that has high aspirations of driving revenue and increasing their bottom line. For example, building a new warehouse to house widgets, that building cost could amount to something like $100 million plus, right? Now, the company has to take a hard look in the mirror and determine what's the best way for us to raise $100 million. And a lot of times these larger corporations we're going to talk about here in a minute will have a bit more wiggle room in terms of how they're going to raise this capital. Larger corporations can sort of throw their weight around just a little bit more because they can read the macroeconomic environment and determine, well, if interest rates are a little bit higher, it might not make as much sense to issue debt. They might be able to issue some equity in order to raise this money, right? So again, it comes down to sort of reading the room, as we like to say. Another option that these larger corporations or companies that are getting ready to go public might have at their fingertips is going public or issuing equity, right? So they can issue equity or stock in the business, whereby providers of capital that we'll get to in a second will then share in the ownership of the business, the successes, the failures, and everything in between. And in turn, the company will end up having money to use to finance a lot of their projects. So what's best for the company, it really depends on the growth stage of the business itself and what the macroeconomic environment tends to look like at that stage. Anything to add there, Matt?
I was listening to, I think you got it covered, Dylan.
Perfect. Accessing capital, as we alluded to earlier, there's a few factors that users need to consider. And sometimes, unfortunately, for the little guys that are in growth mode, they don't have as many choices as the larger businesses, but all the more incentive to grow and become a healthier business. And so by that, we effectively mean smaller companies may not be in a position to issue debt. Their cash flow might not be healthy or consistent enough to be able to establish an agreement with an investor to where they receive money from the investor and then create regular payments back to that investor and then pay par value back to the provider of capital at the end of the bond term, which we're going to get into a little bit more in a second.
Because they're perceived as greater risk, right?
Right, exactly. Yeah. So smaller companies, in that case, they're greater risk because cash flows may not be as consistent. They may have less customers, less clients. So it might be lumpier cash flows earlier on, but that's okay because a lot of times these smaller businesses can issue equity. Now the downside there is when you issue equity, you're foregoing some of your own ownership in your business. So again, it comes down to a trade-off, evaluating where you're at in your growth story and what your short and long-term objectives are, and really what to a lesser extent than bigger companies, what the economy is looking like at that stage. Now, medium-sized companies, again, as you grow, you tend to have a few more options at your fingertips. Going public comes with various pros and cons. Again, similar to issuing equity, you're foregoing some form of private ownership in lieu of public ownership. So, public investors can now buy stock in your business. So that may or may not make sense at various stages. But debt also, too, as your cash flows become more consistent to the point that Matt alluded to, as a medium-sized company, you likely have a wider range of customers, a lot more diversification in terms of how you generate revenue for your business. And therefore, repaying debt may not be as risky for you as a business owner because you have far more of a consistent revenue stream. So the options start to open up a bit more.
And at the same time, I was going to say, Dylan, is, even still as a medium-sized company, if you do choose to go the debt route because you maybe have more reputation, maybe you have a greater cash flow, you still might be paying the bank or the investor a greater level of interest, because maybe you're still not a large company, you're still a medium-sized company, so there's still risk there. And because there is risk there, then that medium-sized company is going to have to pay a greater interest payment in order to get that capital. So that's the other piece of the equation that needs to be considered. Well, how much is this debt going to cost us?
Yes, exactly. Great points. And then with larger companies, to some of the points that Matt just brought up, larger, more established businesses with consistent revenue streams may not be seen as much of a risk in the eyes of the bank, the debt issuers, et cetera. So therefore, issuing debt might be more attractive because again, they're very comfortable making those regular payments. Now, again, equity is always on the table, but larger companies comes down to how much do they want to dilute their ownership and different situations of that nature. But a lot of times the options available to larger companies are far greater than smaller businesses, and they can really evaluate what's best for their business based on the economy at that point. Now, providers of capital, I always like to replace the providers word with investors. So investors of capital, typically this can take two different shapes. So either you can invest in businesses by owning equity or debt. So when you buy into a business or own equity in a business, as we alluded to on our previous slide, you're along for the ride, as we like to say. So you're investing in, let's say, you own Apple stock. You share and participate when Apple does well. When Apple perhaps misses earnings on the downside, you'll see your stock or your ownership go down in price. So it's a risk-return trade-off, as we're starting to set the stage for. Owning equity in a business is one way to ensure that, again, you're invested in the company in terms of how well or poorly they do. So a lot of times providers of capital need to take a hard look at their personal investments and determine how much risk they're willing to take when providing money to these various businesses, individuals, or municipalities across the country. So think about equity as stock and ownership, and you're along for the ride. Now, debt, I think it's always important here to start with the basics of how bonds work. Bonds are effectively an agreement whereby an investor effectively, a lender, a provider of capital in this case, promises to lend a certain pool of money out to, again, a user of capital. It can be a company, individual, or in many cases, a municipality. And the agreement is to receive your full par value back at the end of what's called the bond term, or in this case, the maturity date. Now, along that relationship, the user of capital promises to pay the provider a coupon rate, the interest rate for lending that money. So again, it's an agreement. So you can imagine in this case, given the relationship and the structure of how bonds work, lower risk, but lower potential reward. It's more of a promise, if you will, to receive par value back while receiving this interest rate along the way. So less upside, but less potential for downside. Now, again, when it comes to providers of capital, they're always continuously evaluating the best way to invest in companies or municipalities. And it does come down to a risk-return trade-off in a lot of ways too. So you're not sharing in the success or the ups and downs of the business directly per se, but it is another form of an investment. Did I miss anything on that point, Matt?
I don't necessarily think so. I think one additional thing that was worth adding as well is with regard to bonds or debt. If you are an investor, if you are a provider of capital, and you have an opportunity to provide uh, or to provide lending to a user of capital, depending on how long that maturity is, can also help distinguish the type of interest payment you're going to get. So, for instance, if you have a maturity of, let's say, 1, 2 years, well, that's kind of a short period of time, and that company only needs to be around for a short period of time in order for me to get my money back. So, therefore, because it's a less riskier debt, I'm going to take on a lower interest payment, a lower interest payment in return. However, if that debt, if that me lending is going to be like a 10-year lending over a 10-year period, well, that naturally is going to be riskier, and so therefore the interest rate should be larger in return. And that's what kind of that idea is what we call sometimes called the yield curve. The yield curve being that shorter term debt that matures in a shorter period of time is less risky, where and with a lower interest rate, where debt that is longer in duration, longer in maturity, I should say, will generally have a greater interest payment. And that's ultimately why you think of a yield curve as being a vertical yield curve. And granted, there's some nuances behind that, but that's the general idea.
No, good points, and good add-ons. Duration is an important topic, especially in today's interest rate environment. So you'll likely see duration talked about a lot, depending on what channels you get your news and investment updates. So we talked a little bit about equity versus debt. Now that we've provided an overview on the pros and cons of each, the risks inherent with owning equity versus bonds or debt itself. We always talk about this example, in terms of comparing different investment opportunities. And at the end of the day, Matt and I always have a fun discussion on these two investment opportunities leading up to this discussion every summer, because at the end of the day we think it comes down to risk tolerance, right? So if you're faced with two different options for how to invest $1,000, which we've laid out here, investment opportunity A is being summarized by $1,000 that can be put towards your 8-year-old neighbor's new board game business, right? Now, as a provider of capital, right? The way I view this example is it really comes down to risk return. So $1,000 invested toward a board game business run by your 8-year-old neighbor, likely higher potential risk. I would only be willing to invest $1,000 and own potentially some equity in this business if I was very comfortable with my $1,000 going down to zero at the end of the day. This is more, in my eyes, a gamble than an investment. But again, if you're willing to be in it, committed long term, and you have other investments that are going to complement this particular opportunity that are a bit more stable, certainly, is something worth pursuing. But you might ask your 8-year-old neighbor if he's willing to issue a little bit of debt if his business is stable enough to be able to make some regular coupon payments. But I would highly doubt that he's at that stage just yet. He or she's at that stage. Investment opportunity B, $1,000 invested toward Bill Gates' new software business. Now, here is where you have to look at it also from the user of capital. So Bill Gates starting a new business would probably be at a stage where he has the option to issue both equity or debt. So if you're given that option as a provider of capital, again, comes down to your personal risk tolerance. How is your overall portfolio constructed? Which Matt's going to get into a little bit more detail here in a second, but where are you at on your potential retirement journey? How soon might you need this $1,000 to cover expenses, to live off of, etc.? It's worth taking a hard look in the mirror to determine how comfortable you are with risk. Now, if Bill Gates is willing to issue equity, and you can use your $1,000 to buy equity in Bill Gates' new business, there's probably a place in your portfolio for an investment like that. If you want to be a bit more stable and see yourself as a bit more risk averse, $1,000 in debt or bonds in a Bill Gates run business might be a bit more stable, provide you with some regular income stream, and there's probably a lower risk of defaulting than, again, your 8-year-old neighbor. So there's different ways to look at these examples. At the end of the day, and this is what we're trying to set the stage for, it comes down to your personal risk tolerance, your short and long-term goals for your portfolio. What this all set the stage for is asset allocation. So between the different types of investments for providers of available to providers of capital, debt, equity, and again, as Matt will get into, alternative investments. How you combine those different types of investment vehicles and in the various weights across your own portfolio comes down to your appetite for risk, your financial plan, and where you're at in your journey, both short and long-term goals. But as we started to describe, being more exposed to equity could mean, again, a bit more volatility across the portfolio. But younger investors, they could potentially afford to ride the ups and downs of the market. We have a lot of conversations with our clients that have various 401ks or qualified retirement plans, and there are going to be decades before we would even suggest them starting to consider tapping into those retirement vehicles. Therefore, afford to ride the ups and downs of the market over that time period. So you might want to be a little bit more tilted to equities. And again, it's a personal decision, all depends on your situation, but typically from a time horizon standpoint, how we start to look at things. Now, as you start to get closer to retirement age and having to withdraw from retirement accounts, you might want to shift a little bit more into fixed income as more of a stability asset that is going to be there when you need to begin withdrawing from those accounts. Now, again, this is where I start to hand it off to Matt, who's going to get into the role of alternative investments, which, as we like to say around here, should zig when the market zags, right? Should offer a bit of diversification compared to just the standard stocks and bonds out there. But I think a common misconception that we'll address is that alternatives shouldn't be seen as just this aggressive asset class. There's ways to utilize alternative investments to complement and be a bit more stability minded than and provide some complements in just the traditional bonds in the portfolio. So, and then of course the lowest risk investment that you can have is cash, and depending on your appetite for risk, there may be room in the portfolio for a little bit of cash, but typically we'll reserve that for emergency fund uses, if anything. So to that end, I'd like to start to hand it over to Matt to discuss asset allocation, the role it plays in investing short and long term.
Yeah, thanks, Dylan. So what is asset allocation? Of course, Dylan went through the three broad asset classes, stocks, bonds, alternatives, as well as cash. So what asset allocation is in what combination and what mix do you create those mix of assets? So perhaps you can have a portfolio of 50% stocks, 25% bonds, and 25% alternatives. And that asset mix or that asset allocation could provide a certain target level of return at a specified amount of risk over a period of time. And let's say longer term, we like to think longer term is over a 5-year period, if not longer than that. And so why is asset allocation so dang important? Is because it is the #1 driver of portfolio outcomes over these extended periods. So you can think about it this way. There's 3 main drivers of portfolio outcomes. One is market timing. One is actually security selection or manager selection. And the third and the final one is asset allocation, what we have been talking about. Asset allocation drives over 90% of portfolio outcomes over a longer period. So you can imagine if it's the biggest driver by a lot, then that's something that an investor and certainly a wealth manager is going to look at very closely when constructing a portfolio. And then, as I mentioned also earlier, is that asset allocation is also going to help drive, well, how much risk am I willing to take on in my portfolio? And if you understand your level of risk that you're willing to take on, well, then the combination of those assets or those asset classes might change a little bit. So we talked about asset allocation. One thing that we have not really dove into very much is alternatives or alternative investments. And so what are alternative investments? Essentially, an alternative investment is anything beyond outside of a traditional stock or bond allocation. So the universe of alternatives is vast, right? You can have real estate in there, commodities in there, private equity, private debt. The list goes on. And even within all those, you have what we call private alternative investments. So think of like private equity or private infrastructure or private debt. And then you have other more liquid alternative investments that are daily liquid, but they're just different than your traditional stock or bond allocation. And so for today's conversation, let's kind of focus a little bit more on more of these private types of investments. Oftentimes there's less liquidity. That's something that needs to be considered as always. One of the reasons why investors appreciate these alternative investments is because they are less correlated to stocks and bonds. A stock and bond correlation can support each other over large market timeframes, because oftentimes there is some level of inverse relationship. But if you add a third category of investments like alternatives, it adds another layer of diversity and diversification in the portfolio. And so that's another reason why we like it. Another thing with alternative investments, particularly private alternatives, is oftentimes they're not super transparent. It's not very 100% clear of like what these investment strategies are investing in, which is why it's very important that when you are purchasing alternative investments in your portfolio, that you know exactly what you're buying and you know the risk return profile of that particular investment. And that kind of goes also with the risk return trade-off as well. In short, having a basket of alternative investments in a portfolio can ultimately help seek greater levels of return with a certain amount of risk that you're okay with taking on. And so what we see here is kind of a quadrant of what alternative investments can do. And what we can do is look at the examples of alternatives: real estate, hedge funds, private equities, and commodities. Kind of utilize that as a little bit of a word bank to fit within these four different categories. So let's think of total return enhancers. Compared to traditional investments, higher expected return, but higher expected level of risk. Well, of these four, real estate, hedge funds, private equity, and commodities, what fits best in there? I would say private equity probably fits probably best in that particular square. Real assets, one reason why you might add real assets to a portfolio is because oftentimes real assets move up with inflation. So they can be a certain level of inflation protection in the portfolio. And on top of that, just like we've experienced over the last a couple 1 to 2 years now, is gold as a real asset does not move in lockstep correlation with traditional stock and bond markets. And so I would put the commodities within the real assets. Granted, yes, one could argue that real estate could fit in there as well. Real estate is a real asset, but with respect to what we're talking about in this particular quadrant, I would put commodities. Another one is a non-correlated strategy. So alternative sources of return that are not dependent on the success of traditional markets. Investors enjoy this piece. If I can get a 7 to 9% level of return, but it doesn't move with the stock market or the bond market, well, that's something that's valuable to me and it keeps my portfolio more stable. And oftentimes an individual will look to hedge funds as a way to do this. Hedge funds in itself is a very vast asset class. You have super high risk hedge funds where you're seeking high levels of return with a high levels of return for a high risk. But at the same time, there are also hedge funds that you can add to an investment portfolio that are not. They're more a defensive assets in the portfolio, and so that's what I would put in that particular quadrant. And then
Reading the market environment too a little bit, Matt makes sense in this case too, right? Where, for example, everything we've gone through so far this year with concerns over the impact that tariffs could have, does this force us into a recessionary period?
yeah.
Having some form of non-correlated strategies that if corporate profits contract, we find ourselves in a recession, alts can play a role there and perhaps make your 60/40 portfolio look a little bit different than just a regular 60/40 consumed with stocks and bonds, right?
Yeah, I think you're exactly right. Whenever there's a certain level of uncertainty in the market, I mean, let's go back to 2022, Dylan. Stocks were
Yeah.
down over 20% at one period in time. I think over 18% at the end of the year. Bonds at the same time, which is very rare, were down over 12% at the end of the year. But the alternative sleeve of a lot of client portfolios are actually positive. And if you only had a stock and bond portfolio, man, you kind of wish you had an allocation to alternatives in the portfolio that was a little bit of a buoy. Granted, it doesn't mean that alternatives are a silver bullet, but they can certainly help with risk, as well as maybe even seek greater levels of return over longer periods.
Well said.
And then lastly, the last one is risk reducers. Compared to traditional investments, similar expected return, but lower expected risk over full market cycles. I would stuff real estate into that particular category. I think that if you look at real estate relative to, like, let's say equities, real estate can have an attractive return. It's kind of similar to equities, but oftentimes real estate can be seen as being less risky as well. All right. So, we've talked about investments, how to kind of build a portfolio with different asset classes, what alternatives are, but I think risk tolerance is one of the biggest drivers of, well, what does your portfolio look like? As Dylan and I being investment advisors and wealth managers to our clients, we look at risk tolerance very, very closely because here's the thing is, risk tolerance is going to be a pretty big variable with respect to what the portfolio looks like. And one other thing that I think is worth noting is there is a difference between risk tolerance, which is kind of your stomach for risk, versus risk capacity, right? And they might not be in line with each other. As a sake of an example, if you have a 30 or 40, if you're a 30 or 40-year-old and you have a 20 to a 30-year time horizon, well, your capacity for risk is great. You could be 100% equity or private equity portfolio because your time horizon is so significant. However, your tolerance for risk, your stomach for risk might be completely different. And the reason why that needs to be considered is because the last thing that you want to do as an investor is when markets get ugly. And here's the thing is markets always get ugly, unfortunately. But you don't want to have to sell your investments. You want to be able to ride that roller coaster through ugly and weird and market downturns. And so understanding a risk tolerance is going to be in your risk tolerance is going to be incredibly helpful. And that's where, it's like, all right, well, let's say I'm in my 40s and 50s, and I recognize that I do have a greater risk capacity, but I can't take the market risk. It doesn't allow me to sleep at night when I see that, Apple's down 20% since the beginning of the year. And so what that might mean is like, all right, well, maybe we probably should maintain some allocation to equities in the portfolio, but at the same time, maybe we should have a combination of some bonds as well as some alternatives in the portfolio. The way that I always like to think about bonds is bonds are boring. They're meant to be boring. They have a yield right now, actually, which is higher than they have been in 15 years of, let's say, somewhere between 4 to 6%. And that's great, but the beauty behind bonds, which I've alluded to earlier, is oftentimes when markets get weird, there's this inverse correlation of stocks and bonds. And so that's one reason why we might have bonds in the portfolio. But the nice thing about like a sleeve of alternative investments is you can seek, let's say, somewhere between a 7 to maybe 8, maybe even a little bit more level of return. And so they're not as boring, but you're able to generate a nice level of return as well. And so, looking at equities, bonds, as well as alternatives, ultimately is going to help you figure out what is the best asset mix given where you are in your life at the same time your risk preferences.
We like boring, don't we, Matt?
Boring sometimes is not so bad.
Right. This risk tolerance piece is important. Matt and I spend a lot of time working with clients on this component here. Matt said it best, and I think another way we look at risk tolerance is the combination of your ability and willingness to take risk on. So that capacity and your willingness to take on risk at any given point. So working with an advisor up front to get that asset allocation done right from the beginning is important, because to the points Matt brought up, it helps you stay the course during both the good and the bad and come out the other side stronger.
So how do we figure out what your risk preferences is? Well, one way that we do it here at Beacon Point is we like to start with a risk questionnaire. Granted, the risk questionnaire is not the end all to be all. It's not the number one and only decider of what your portfolio is going to look like, but is it a good starting point? And so oftentimes we'll have our clients take a risk questionnaire, but then also we'll go into a very a meaningful conversation to understand what a person's risk preferences are, not when markets are looking good and feeling great, but really when markets are not so pretty. And as I mentioned earlier, there's very few guarantees that Dylan and I can talk about in investing, because there just really are not many that we can say. But one of the guarantees is markets always get ugly. That is the kind of the one guarantee, and it behooves you to make sure that your portfolio is the risk profile of your portfolio is adjusted for your preferences. And so it is a very important aspect of what it is that we do for our clients, and for you who's perhaps managing your own self-directed portfolio, something that you want to pay special close attention to as well.
We often say that we'd rather get our house ready for the storm ahead of the storm hitting than versus in the middle of all the chaos and the storm hitting your home. You want to batten down the hatches in preparation. So that's what we try to do with getting risk tolerance identified and correct.
Yeah, absolutely. So that wraps up our class 2. Hope that you all enjoyed that. Cindy, do you want to take it from here?
Yes, happy to, Matt. Awesome. Well, thanks both. And before we wrap up, don't forget to connect with us online. Just open your phone's camera and scan the QR code. Easy as that. You'll find our latest blog and article content, social media pages, and the Your Dollars, Our Cents podcast, hosted by 2 of our Beacon Point Wealth advisors. That's it for today's class. Thanks for joining us, and we'll see you next Wednesday, June 25th at 11 a.m. Pacific for session 3, Investing in the Role of a Money Manager, with special guest Larry Riddell of St. James Investment Company as our guest professor. Thanks again for tuning in.
Thanks,
Everyone.
Sydney.